If you think the biggest tax risk in America is that politicians might take a little more from billionaires, then you are staring at the bait and missing the mechanism. The mechanism is the real danger. That is the first thing I want you to understand. Governments almost never begin by telling the middle class, we are coming for you next. They begin with a villain. They begin with a target almost nobody wants to defend. They begin with a slogan that sounds moral. They begin with a number high enough that ordinary people say, that has nothing to do with me. That is how the door gets opened. Then the threshold moves. Then the justification grows. Then the exceptions multiply. Then the administrative machinery expands. Then the people who were told they would never be touched discover that they were not looking at a tax, they were looking at a template. That is the real story here. Not whether California taxes one billionaire class today, not whether one ballot measure passes this season, not whether one politician says the quiet part out loud. The real story is that once the state builds a practical mechanism for inventorying what people own and charging against that ownership, the line between income and property begins to blur. And once that line blurs, your house is no longer just your house. It becomes part of a tax base. That is the first mechanism. I call it the threshold slide. A threshold slide is what happens when a tax is introduced at a level most people find emotionally easy to support precisely because they assume it will never reach them. This is not a new trick. America did not start with an income tax as an everyday feature of life. Then the structure got introduced narrowly, the rates moved, the thresholds widened, and over time a thing that was sold as targeted became normal. That is not conspiracy, that is precedent. The source material uses that history for a reason because governments rarely admit the long road at the beginning. Fay Falasite Fay Turn. 52 file 0 Fay. That is why I never focus first on the rate. I focus on the mechanism and the threshold. I have 5% tax on billionaires. Sounds like one story. The authority to assess net worth annually is a very different story because once the authority exists, rates can move, thresholds can move, definitions can move, exemptions can shrink. Emergency justifications can multiply, and every time the public finances get uglier, somebody will discover a fresh moral reason why the line should be moved again. That is the danger, not the opening number, the slope. Now let me tell you why this matters. Far more than people think. A tax on income is one thing, at least income is flow, it comes in. It is earned, it is counted, it can be taxed, you may hate it, but you understand the battlefield. A tax on net worth is different. That is a tax on accumulated life. That is a tax on what you already built. That is a tax on your house. Your equity, your savings, your investments, your business value, your vehicles, your collectibles, your land, your stored work in material form. That is the second mechanism. I call it the inventory state. The minute the state wants to tax ownership rather than only income, it needs something first. It needs a map, not a rough map. A detailed one. What do you own? What is it worth? What changed since last year? What appreciated? What was transferred? What is hidden? What is jointly held? What sits inside trusts? What sits inside entities? What is difficult to price? What can still be assessed anyway? That is not a tax return. That is an annual inventory of your life. And if you think the government would never build that kind of machinery, you are not studying the right century. The source lays this out through examples of financial surveillance. Credit scoring, digital monitoring, aerial property assessment, and the broader pattern that once a system can be built and justified, it tends to expand. That does not require every detail to arrive tomorrow for the direction to matter. Fay file a site, Fay turn 52 file 0 Fay. This is how power works. It does not need a perfect reason to begin. It only needs a reason good enough to sound clean in the opening argument. The third mechanism is what I call home equity exposure. A lot of homeowners still think the house is protected psychologically because it feels personal. That is exactly why it is vulnerable. Your home is not invisible. It is documented, it is titled, it is assessed, it is mapped. It is visible from the road and increasingly from the sky. That makes it administratively convenient. And whatever is administratively convenient eventually attracts taxation pressure when governments run out of easier prey. This is why I do not laugh when people say a wealth tax mechanism ultimately becomes a home equity story. Of course it can. That is where the value is. That is where the records are. That is where the emotional resistance is weakest because it gets framed in layers. At first it is the ultra-rich, then the very wealthy, then the asset-rich, cash poor, then the undertaxed owner class, then the people sitting on excess equity. then anybody whose house appreciated beyond some politically convenient threshold. That is how language prepares confiscation. It moralizes the dissent, and homeowners never see the whole staircase because they are too busy arguing about whether step one feels fair. I do not care whether step one feels fair. I care where the staircase leads. That is the fourth mechanism. I call it the promise machine. Governments do not usually raise taxes because they enjoy abstract cruelty. They raise them because promises piled up faster than reality. Pensions, benefits, programs, projects, entitlements, subsidies, bailouts, legacy commitments, political gifts dressed as compassion. Each one is sold as manageable. Each one is added to a future bill. Each one pushes the machine a little further. And when the bill finally arrives, the answer is almost never smaller government. The answer is new money. That is where the danger intensifies. Because once traditional revenue sources no longer cover the promise machine, the state starts looking at stock, not flow, not what you make, what you have. That is the shift. And it is a profound one because taxing flow still leaves the accumulated base somewhat intact. Taxing stock goes after the base itself. That is why home equity matters. That is why accumulated wealth matters. That is why these proposals are never just about this year's revenue. They are about redefining what counts as reachable. The fifth mechanism is what I call the ownership illusion. Most people use the word own too casually. They say they own their house. They say they own their land. They say they own their assets. But what does ownership mean if a third party can continuously reassess the value, set a charge against it, and force payment based on a price you may never have chosen? That is not full ownership in the old human sense. That is conditional possession under administrative supervision. You may still hold title, but title under permanent reappraisal and recurring extraction is not the same thing as sovereign control. This is why I say the real issue is not one tax proposal. The real issue is whether property in America is gradually becoming more contingent than people emotionally realize. Corporate America already taught this lesson in a different form. People buy digital goods that can be remotely disabled, features that can be revoked, platforms that can be changed after purchase, systems that quietly remind you that use and control are no longer identical. A wealth tax regime extends the same logic into property itself. You thought you owned it. The system says you possess it on terms. That is a very different civilization. Now, let me say something even more uncomfortable. Most people will not resist this structure at the beginning because they will not identify with the first victims. That is the sixth mechanism. I call it the distance lie. The distance lie says, this is about them, not me. Them, the billionaire, the mogul, the trust fund heir, the tech founder, the landlord with too many doors, the person with too much stock, the person with too much house, the person with too much accumulated everything. Fine, the public says yes because distance makes policy feel painless, but distance collapses over time. The same public that cheers a tax on faraway wealth eventually discovers that definitions drift and that what once felt untouchable becomes surprisingly ordinary. $1 million once sounded untouchable, then not so much, then a paid-off house in the wrong zip code plus a retirement account plus some equity, and inflation does the rest. That is how thresholds become ambushes, not because everyone got rich, because the measuring stick moved. That is why inflation matters in tax systems more than most people understand. Inflation drags ordinary people into categories originally designed to sound exclusive. The number stays fixed, the purchasing power changes, the net widens, and if you are not watching the mechanism, you will not notice until you are already inside it. Now let us talk about what people should do with a story like this. Not panic, not run around screaming that America ended yesterday. Panic is expensive, but complacency is lethal. That is the seventh mechanism. I call it the quiet fortification. If a system begins moving toward deeper asset visibility, deeper assessment power, and broader taxation logic around ownership, then the rational response is not hysteria. It is structure, clean legal structure, thoughtful asset titling privacy, where legal entity planning, where appropriate, trust planning, where appropriate, debt positioning, where sensible, liquidity outside any one choke point, and a serious understanding of what is in your name, how visible it is, how levered it is, and how exposed it is to future reclassification. That is adult behavior, not because it makes you untouchable, because it reduces the ease with which your life can be turned into a spreadsheet line item for future politicians. The source talks about building a war chest not only of cash but of hard assets and strategic legal structure and stripping visible equity where appropriate. Whether a person follows that exact mix is less important than the principle underneath it. If the mechanism is expanding, passivity becomes a decision too. Fe file site fe turn 52, file 0 fe, that is the principle. Do not sit still in front of a mechanism that is clearly trying to learn your shape. Now let me be equally honest on the other side. Not every proposal becomes law. Not every scary headline becomes national policy. Not every state becomes California. Not every election hands victory to the same coalition. Not every tax idea survives contact with capital flight, public backlash, administrative difficulty, or constitutional challenge. All true. But that is not the standard I use. I do not need certainty to prepare. I only need direction. And the direction here is obvious enough. The state is under pressure. The promise machine is hungry. The moral language around taxing stock rather than only flow is becoming more mainstream. The technology required to monitor, assess, and automate that pressure is stronger than it used to be, and the psychological testing ground is already visible. That is enough. The eighth mechanism is what I call the canary effect. The source opens with California as a canary, and that is the right instinct. A canary is not important because it predicts every detail of your future. It is important because it reacts early to a condition others will only feel later. Fe site, fe turn 52, file 0 fe, that is how you should think here. The question is not whether your state will become an exact copy. The question is whether the political appetite, fiscal pressure, and administrative technology visible in one place can migrate. Of course it can. That is how bad ideas travel. They travel by being tested where resistance is weak and then moralized for wider use. That is why I do not dismiss state experiments as local theater. State experiments are prototypes, and prototypes matter. Now let me leave you with the cleanest version of this whole story. The real danger is not that the government wants to tax one hated group more. The real danger is that once it builds the power to measure, reassess, and tax ownership itself, that power will not politely remain confined to the people you do not feel like defending. That never lasts. The threshold moves. The language shifts. The promise machine needs more. And eventually the question is no longer, should the rich pay? It becomes, what counts as rich now? That is when ordinary homeowners discover the mechanism was never just about billionaires. It was about inventory. It was about accessibility. It was about visibility. It was about turning what you built into something the state could continuously price and tap. And if you want one line to remember from everything I have said, remember this: the first tax is on the villain. The durable tax is on whoever cannot move fast enough once the villain runs out. That is where the real danger lives. Not in the slogan, in the mechanism hiding behind it.